Modern Real Estate Practice, page 278, continued. The phone died right at construction loan. A construction loan is made to finance the construction of improvements on real estate, such as homes, apartments, and office buildings. The lender commits to the full amount of the loan, but disperses the funds in payments during construction. These payments are also known as draws. Draws are made to the general contractor or the owner for that part of the construction work that has been completed since the previous payment. Before each payment, the lender inspects the work. The general contractor must provide the lender with adequate waivers that release all mechanics lien rights for the work covered by the payment. Construction loans are generally short-term or interim financing. The borrower pays interest only on the monies that have actually been dispersed. The borrower is expected to arrange for a permanent loan, also known as an end loan or takeout loan, which will take out the construction financing lender when the work is completed by paying the principal owed on the construction loan. Page 279. Sale and leaseback. Sale and leaseback arrangements, while not loans, are used to finance large commercial or industrial properties. The land and the building, usually used by the seller for business purposes, are sold to an investor. The real estate then is leased back by the investor to the seller, who continues to conduct business on the property as a tenant. The buyer becomes the landlord, and the original owner becomes the tenant. This enables a business to free money tied up in real estate to be used as working capital. Buydown. A buydown is a way to temporarily or permanently lower the interest rate on a mortgage or deed of trust loans. Perhaps a home builder wishes to stimulate sales by offering a lower than market rate, or a first-time residential buyer may have trouble qualifying for a loan at the prevailing rates. The buyer's relatives or the sellers might want to help the buyer qualify. In any case, a lump sum is paid in cash to the lender at the closing. The payment Let me see where I was at. The payment offsets and so reduces the interest rate and monthly payments during the mortgage's first few years. Typical buy-down arrangements reduce the interest rate by 1% to 2% over the first 1 to 2 years of the loan term. After that, the rate rises. The hope is that the borrower's income will also increase, making it more likely that the borrower will be able to pay the increased monthly payments. In a permanent buydown, a larger upfront payment reduces the effect interest rate for the life of the loan. In practice, as recent history has shown, a borrower should not overestimate the ability to meet future payment obligations. Holding on to employment with or without an increase in income may be the best that can be managed. The risk of incurring a property foreclosure should be carefully considered. Home equity loan. A home equity loan is a source of funds that takes advantage of the equity built up in a home. The original mortgage loan remains in place. The home equity loan is junior to the original lien. Although the home equity line of credit will carry a higher interest rate than a purchase loan, it is an alternative to refinancing because only the amount borrowed will be subject to the higher rate. As an added benefit, the interest paid on a home equity loan of up to $100,000 is deductible from federal income tax. A home equity loan can be used for a variety of financial needs, such as to finance the purchase of an expensive item, such as a boat, consolidate existing installment loans or credit card debt and pay medical, education, home improvement, or other expenses. A home equity loan can be taken out as a fixed loan amount or as a line of credit. With the home equity line of credit, called a HELOC, a lender extends a line of credit that the borrower can use at will. One downside to a HELOC is that the full amount of the line of credit will appear on the borrower's credit report, even though it is not being used. On the upside, the home equity loan could eventually lead to a new first mortgage loan. The homeowner could refinance all outstanding mortgage loans at some point with a single new loan at an attractive interest rate, in which case the original mortgage loan and the home equity loan would be paid off.